Welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Now let's make some money and get a lot smarter. And in order to do that, I think you have to understand what in the world is happening to the stock market after Labor Day. Growth fears have returned to the market, and those growth fears have descended on the market's favorite stock, Nvidia, or NVDA, on the Yahoo Finance platform. And there are a couple things going on here. First, out of the block, Nvidia lost $279 billion in market cap on day one of trading after Labor Day. I mean, just market value completely disintegrated here. That is the biggest one-day market cap drop for a U.S. stock in history. I mean, just a stunning drop. Now, secondarily, not helping sentiment around Nvidia is that the company has received a subpoena by the Justice Department seeking evidence that the chip maker violated antitrust laws. That's the last thing you want to see on the same day your stock is getting essentially creamed or disintegrated. However, I'm here. I want to be the voice of calm, want to be the voice of reason, want to be that smiley guy just trying to make sense of everything happening in the market. Now, if you're a trader, maybe Nvidia shares are not your vibe right now because it could very well stay under pressure. Sentiment has gone against this momentum name. However, if you are a true investor, you look at the fundamentals, you look at the sales and earnings, I think it's very important to keep these two things in mind. And as long as they're intact, it's likely that the Nvidia growth miracle, the fundamentals of the business are very much still intact. First up, the company's Blackwell chip demand is starting to pick up in a very big way. It is likely to accelerate into the fourth quarter. That is a very good thing because if it accelerates into the fourth quarter, it's likely to accelerate even more next year. That means more billions of dollars for Nvidia's latest and greatest chip that's charging premium prices on. That is good. That is good for sales, profit margins, net earnings, cash flow, you name it. I can go on and on and on, but my hand starts running off the screen. And then number two, you look at the business overall. In the October quarter, that's when we will hear from Nvidia again. The results for the business are supposed to, across the board, every segment for this company, they're supposed to see sequential double-digit growth. If Nvidia is growing at double digits sequentially, that is a very good thing, and not only likely justifies the valuation the company has received, and you can check that valuation out on Yahoo Finance, the statistics page. I love calling that out. It likely justifies where the company is valued at longer term. So I just need to get that off my chest because it is wild times and all thing Nvidia, one of the market's favorite stocks. But let's stay on what we're seeing in markets here. I got a really cool guest with me coming up here on Opening Bid. State Street Head of Equity Research, Marija Whitman. Marija, good to see you. I wish we were here talking about better things than stocks getting creamed, but nonetheless, as a former longtime analyst, it's always exciting for me to talk to all folks in equity research. So I thank you for coming on here and talking with us. Let's just take a step back here. What do you think we are seeing in markets after Labor Day? Why all this selling pressure?
Yeah, first of all, good morning, and thank you very, very much for having me on the program. Yeah, I have to say, I was very, very surprised seeing the price action yesterday. I mean, we didn't really see like huge kind of negative news, huge negative surprises, and kind of going through the checklist of things, what could have gone wrong. I mean, other than calendar, other than people coming back from holiday and thinking, okay, what do I do with my portfolios now? I mean, doesn't look like any kind of big news. Okay, we had this big kind of recession scare in August, post payroll reports, and then we had quite a substantial kind of rethinking of Fed policy and cuts, and kind of market got comfortable with that. And maybe now we have we're coming to a next payroll report, and people are worried and jittery and potentially selling their big winners. So, and tech sector, Nvidia specifically, I mean, performed really, really well over kind of recent months, and I don't know how far back investors have positions. So maybe they sell some winners, take some profits, like lighten up positions ahead of payroll, but really nothing super fundamental, like you were saying, that like tech sector, Nvidia, I mean, fundamentals look strong.
From one former researcher to a current researcher, is it hard to I remember it was hard when I saw big sell-offs in the market. I would go back and I would look at my models. I would try to turn the TV off and just forget what was going on. But what do you do when you see the market as volatile as it has been, really, I would say, over the past month? Because August was no great shakes to start the month either as well. I mean, how do you recalibrate things? Where does your mind go?
I mean, we like at State Street, we are kind of big believer in kind of investor sentiment and kind of positioning and kind of flow of money, risk appetite type of research. And kind of our thinking of the market is kind of the big theme we kind of been talking about is AI demand and tech sector fundamentals are kind of independent of business cycles. So market is really worried. Are we going to go into recession or not? Is Fed going to cut and how much it will support like earnings and profitability in companies that really struggle, like small caps, like manufacturing companies. But tech is independent of that. So that's a really big thesis for us. So almost like no matter what happens with business cycle, we know that demand for those super fast chips is very strong. We see order books for semiconductor companies being really, really solid. So profitability is there, profitability is strong. So to us, it's more kind of lightning positions than anything fundamental.
Hey, to your point, I'm with you. I don't see it. I mean, I look at those Nvidia earnings when they reported a week and a half ago. I look at a lot of the companies that I'm still out there researching. It's double-digit growth. And Marija, it's not just double-digit growth in the second quarter. These are companies that are calling out. I look at even Dell most recently, calling out accelerating revenue and profits for all things A, and not just this year.
Absolutely. So think about Nvidia. Margins are 50%. I mean, how many companies you can have with that margin? Exactly right.
I mean, do you think, so basically what we're seeing is the market just is the market, I guess, I mean, this is probably a good opportunity if you're a longer term investor to start kicking the tires in some of these names, no?
Yeah, no, I would not be surprised. I mean, in August sell-off, we called to buy the dip. That seemed to be kind of the right attitude. And I probably have to add, and I know it's, I don't know, it's probably wrong for analysts to kind of to be over-reliant on this idea of Fed put. But what we heard from Chairman Powell and Jackson Hole is that labor market is not inflationary. That was his kind of key message, which means that his focus, labor market is slowing, and policy is there to somewhat support labor market, and it's not inflationary. So we are definitely can expect central banks to help out labor market, to help out economy and stock market. But by extension, should we see some concerns about growth? So that to me is a really, really strong reason really to be optimistic on stock market going forward.
And do you think next year, and it's hard to think longer term when you're seeing the market just get hammered the way it has after a day, but nonetheless, I'm going to give it a whirl. I mean, so when you're constructing your models, you're in your models thinking about, you know, how much company cash flow and earnings a company can make next year. How many rate cuts do you have baked in for next year? And how powerful are those rate cuts, or how powerful could they be to the bottom line of corporate America?
Yeah, no, that's a super interesting question, because what we've seen is every strategist on the street last year was forecasting so we have higher interest rate, tighter policy. So all strategists forecasted recession last year, and it hasn't happened. And then people kind of came up with long list of reasons saying, okay, why U.S. economy is less rate sensitive. We have the excess savings. We have house owners locked into like rents, locked into like cheap mortgages. So that's not moving. We have lots of savings, strong balance sheets, lots of fiscal spending. So U.S. economy is not that rate sensitive. So kind of hikes didn't cause recession, at least not as fast as people expected. But now market is very, very convinced that the opposite will happen on the way down. So now Fed is going to cut rates, and immediately all the profitability is going to skyrocket. So I'm actually quite skeptical about that. I mean, we'll look at particularly like small cap companies. They usually talked as kind of the great beneficiary of those rate cuts because they are kind of suffering right now. So by kind of let's expect the opposite when rates are cut. But here I'm really skeptical. I look at earnings outlooks, at the earnings forecast for small cap companies and guidance, and it's really revised really sharply down from a fairly low level already. So yeah, and I think, Brian, you're hitting on something and kind of thinking that, okay, we forecast all these cuts and all of a sudden we'll get kind of miracle improvement profitability. Yeah, I'm skeptical. And in that sense, actually, it's really interesting to think about tech sector, right? Because tech sector, as I said, that's probably one sector where kind of independent of what's happening with cuts and economy, because we know the huge demand for AI is there in kind of order book that's baked in. So if we're worried about kind of profitability of non-tech sector, then tech sector looks really attractive.
Wait, there's non-tech companies that exist? I mean, I thought this was just Nvidia and like 6 or 7 other stocks.
Yeah, good point. Good point.
So where are you spending your most time? I imagine, are you spending most of your research efforts drilling into tech companies and AI companies? And then if you, oh God, I hate this, but I'm going to say anyway, if you double click on tech, what metrics are you watching on these tech companies that say, you know what, this might make a good long-term opportunity for clients at State Street?
I mean, for us, margins super important, and cash flow generation. So those two characteristics are really, really important. And once again, like you say, tech and non-tech, it's almost kind of parallel universes. Cash flow generation is really, really fantastic, and that makes those companies kind of immune to, not immune, but more or less immune to kind of cycle fluctuation, how strong their balance sheets are.
Are there any stocks? Is there anything you like that is non-tech? It feels like I used to talk a lot about industrials, but I don't talk about these names anymore. Every day it's just Meta. I don't know. Nvidia.
That's a really good point. And I mean, I've been accused of kind of hogging tech sector and talking mostly about it. But I mean, it's a huge part of the market. I mean, interestingly, I mean, so we are concerned about kind of signs of recession and kind of potential of it, and kind of what Fed can do about it. So companies, sectors with good cash flow generation is really, really important. So maybe healthcare, that looks quite interesting. So that's very cash-rich sector, and like large companies, strong balance sheets. So they look interesting. Like very, very tactically, you can maybe think about like real estate, utilities, so kind of rate-sensitive sectors, so that can do better. But generally, it's quality, it's size. So like stylistically, those type of things that we like. So healthcare, probably kind of your defensive growth, that looks interesting.
All right, hang with us, Marija. We're going to go off for a quick break. We'll be right back. Having a fun chat here on all things stocks, markets, and investing with State Street Head of Equity Research, Marija Veitname. Good to see you here. Really enjoying this chat, and I'm glad you mentioned something besides tech. I mean, healthcare. We used to talk about healthcare, so that is good. I mean, there's historically, to your point, companies that have good cash flow. Some of them pay a lot of dividends. But something you just said really caught my attention. This thought that we are seeing signs of recession. I imagine one of the cool things of your job is you get to talk to a lot of companies. You're ingesting lots of information. Like the companies you're studying, is there anything that would suggest that growth is really going to slow sharply in the U.S. next year?
Yeah, I think like earnings season is always like a really good time to get a kind of a good, like take a pulse of the economy, what corporates are doing. And we heard a lot of concern from consumer companies. So that was kind of, I mean, I wouldn't say it was a huge surprise, but it was kind of big revelations that consumer companies are struggling, and particularly companies that sell to kind of middle class consumer. So it was really interesting. We talk about like those excess savings that stopped us from recession last year, and we knew that like if you do it by income distribution, so lower income consumers spent most of this post-COVID savings last year, and this year it kind of middle-class consumers. So we're seeing like trouble for like auto companies, even luxury goods, when like middle-class consumer buying like aspirational goods like small Gucci bags and like little scarves and things
even
like
those
that.
Gucci bags are expensive. Those Gucci bags aren't cheap, you know.
Absolutely, but let's kind of aspirational purchases. Yeah. So that's we're beginning to see pain. So consumer companies really are really struggling. We know like from macro data that kind of consumer spending, retail sales, they're still positive, they're still growing. But if we look at where they're financed, a lot of it is financed on like credit card and kind of expensive debt. So that's probably kind of the next shoe to drop. And the guidance there was quite weak. And I mean, from where I sit, so I'm based in Milan, in Italy. So like European consumer goods, luxury goods, they're really, really struggling. So we already see that in Europe. So I guess like US is kind of next shoe to drop.
I I love that you're based overseas in Italy. It's because I think a lot of U.S. investors, they just think about U.S. stocks. They don't have that worldview. I mean, to this investor, what are you seeing overseas that is of concern to you or of opportunity that maybe U.S. investors don't understand or they're not even looking at right now because they're so obsessed with Nvidia?
Yeah, I mean, to be honest, very, very fair point is like U.S. stock market, half of the global market, and tech is a huge chunk of it. So I'm not going to blame U.S. investors. But what is really interesting is that when we kind of worry, is like, is U.S. going into recession? Is it potentially in recession things are really bad and like getting worse? I mean, U.S. economic and situation and corporate earnings are so much better than anywhere else in the world. So in Europe and kind of maybe emerging markets, Asia, we're already kind of there. It's kind of pretext of what can potentially happen in US. And as I said, it started with kind of manufacturing demand, industrials, materials, energy stocks being like on the back foot. Then we got consumer and consumer discretionaries and staples. So we see the progression. Things are actually, they look a lot more challenging outside US.
What are you seeing in China? Because I always look through China through the prism of U.S. companies. Again, here am I. I'm focusing on the U.S. The U.S. companies doing business in China. So it's Starbucks, Otis, the very large elevator company. I mean, a lot of these U.S. companies, multinationals, reporting weak results in China. We're seeing the street take down their growth estimates for China. I mean, what's going on in that market, and what are some of your expectations?
Yeah, China is. China is one of those markets where kind of we think about it as a very deep out of the market call option. So we know that it's cheap. It's been underperformed for many years. It's undervalued. We know that people are generally out of the market. So we see institutional investors really underrate this market. We talk to clients. People are really kind of very, very skeptical. So the positioning is low, pricing is low. So you think, okay, so Chinese government is trying to stimulate economy, trying to kickstart growth. So why don't I own some? Why don't I buy some? And people do try tactically, and then you see kind of another disappointment, like latest data was quite weak, manufacturing activity is slowing, the reforms, that kind of the support policies that government is offering, they still seem to be kind of not enough, not clear enough, not strong enough. So we continue to see weakness.
Are you, as someone that I guess studies the fundamentals of companies extensively, how do you factor in the presidential election, and what are your clients? What do they come to you for against a backdrop that is, it's really a jump ball at this point, who wins and then what ultimately happens to U.S. policy?
So I'm going to give you a very, very European answer. So the way we think about elections, hopefully less partisan, less biased, but so the way we think about elections, so we actually have a really cool model to kind of project potential impact of election on financial market. So what we do, we have. These days it's very fashionable. A clever computer to read business media every day. So they read like hundreds of thousands of articles every day and create media sentiment. And so we get media sentiment, how much media talks about elections, in what sense, and what how sentiment is changing. And then we create this election factor, and it becomes a quantitative factor. And then we regress market on it, and we see how important elections are for market overall and for various sectors. And the fascinating conclusion right now is that market, particularly in the last month or so, probably longer, maybe a couple of months, is much more focused on economic indicator, on recession, on labor market, on interest rates, on inflation, than election. So election is something that media talks a lot about it, understandably, but it seemed to have less and less impact on the market. I suspect because we really worry about recession and will it, want it, so that's really important, and the kind of Fed reaction function. So that by far the most important factor. And elections seem to be a little bit on the background. So we're monitoring it kind of every day, and lots of political news, lots of talk about it, but less and less impact on the market, interestingly.
Maria, I feel really bad for your robot ingesting all of those headlines. If I tried to do that, my head would be scrambled. And I mean, it's tough. I mean, it's just wild to cover some of this stuff. I mean, but look, as you see, as we near, if we get closer to the election, I imagine a lot of this chatter is it's gonna switch a little bit from the economy, perhaps, to potential outcomes. I mean, how do you think? I mean, do you have a sense on how the market might react? I mean, just by looking at the data you're seeing now.
I think like before we get into those kind of conclusions about market react, I think, again, like very European take, but so far we haven't seen very strong kind of policy programs from candidates. So we see kind of like lots of like strong rhetoric and Trump drill and things like that, but haven't seen a lot of very concrete policy announcement to get our kind of teeth into it. So I think once we get there, I think then investors can start taking kind of stronger views. But as I said, we are very, very ready with that. So model is there, model is waiting. I think once we get more kind of concrete statements, then we'll start churning out more.
I can't help myself to ask this. What made you create that model? Does media move stocks?
I think so the good way of thinking about this model is so what is important? What is the driver of the market? So I think like people like you and I, we kind of comment on news every day, something happening. So what is really, really important is to say what is important. Like, is Nvidia subpoena important? Is Mexican judicial reform important? So what is it that moving market? Once you answer that question, then you can go deeper and analyze it. Because that's, I mean, time is finite, right? Mm-hmm. so I mean, we can spend all the time thinking about what elections mean for various sectors, but as it turns out right now, that's secondary to kind of economic development. So it's better focus your time thinking about recession probabilities and things like that.
In the last minute and a half we have, Maria, I always like to leave listeners and viewers with something inspirational, happy, and positive. I mean, I guess my question to you on that front is, how can one go about being a more successful investor if they're really struggling, or if they have struggled this year, they have a lot of information coming at them? What's your best advice to them to get better?
I think being disciplined. I think being disciplined with your time. So like the thing we just talked about, is that trying to figure out what's important. So that's one way of kind of being better investors. So work out what's important, and like our kind of media model is a good example of that. So we tell you what's important, and then you spend your time analyzing that. So being very focused, very disciplined.
Well, my answer was going to be just going to Yahoo Finance, watch it every day, and build portfolios on it. But that's just me. I'm clearly.
Or just buy tech stocks. They seem to be going up.
I'm clearly biased. Well, we have to leave it there. I really enjoyed this conversation. You're really cool. Marija Veitname, State Street Head of Equity Research. Welcome to the Opening Bid fam, and we'll be talking to you very, very soon.
Thank you very much for having me, and best of luck investing.
Thanks so much. We appreciate it. And that's it for the latest episode of Opening Bid.